Oh, good evening. I'm Ross from Lifetime Property Accounting, and in a slightly different setup. I'm up in our Auckland office today, and just thought I'd do a quick video. I've been a bit slack, haven't gone through a lot of numbers on what property is looking like. So we thought we'd go through an example and just look, what are the numbers like on a property at the moment? What are things looking like? Had a chat to a property investor today. So we've got a bit of an example that I want to go through. They were looking at home and income in Christchurch. And yeah, we're just going to look through it. So jumped on Google, and this is the first property I could find with the value of the property and also what the rent is. So this is your standard 3 bedroom one side, 2 bedroom the other. It's a home and income in Christchurch and Rolleston, about 1.2 million. It's got two garages, it's two house, so one 3 bedroom, two bathroom, one 2 bedroom, one bathroom. Um, yeah, it's your classic sort of home and income, brick, tile, brand new, low maintenance. Love all of those things. I suppose the big thing that I'm not so keen on or not so excited on is that it's two houses in one. So if you go to sell this property, your buyer market is going to be a whole lot less. It's going to be a whole lot harder to sell, so that could affect your long-term capital gain. If you're selling it in a booming market, awesome, easy to sell things. If the market's a bit harder, you might struggle a little bit with it. So obviously, with any property like this, if it is a new build, you want to be checking things like, is there actually curtains? Is there a washing line? Is everything actually included in this property? Is one of the key. And then also check, does it actually meet healthy homes? Just because it's brand new doesn't mean it'll actually meet the healthy homes rules. Sometimes the heat pumps are not big enough. So still do your due diligence and check things out. The other thing I would always do is I wouldn't just get a rental appraisal. I'd actually talk to a property manager. So, yeah, what's the demand for a 2 bedroom house in this area? What's the demand for a 3 bedroom house in this area? How easy is it to rent? Is there key features that it's going to need? Yeah, because obviously that's going to make a big difference. You want to make sure that, yeah, if your tenants need a garaging, that there is garaging. And I'm just seeing if I can find a bit of an outline for it. But yeah, what I'm sort of looking at with this, it did say that it had garaging. Okay, so it's on a corner, so you've obviously got a garage on each side, a garage to each house. But you want to check, yeah, what's the key things a tenant looking for? Do they want a garage? Do they want off-street parking? What are the other key parts? And make sure your property's got that. So yeah, have a chat to a property manager and actually talk to them. Not an email, not just ask for appraisal, actually a phone call. Yeah, this is what I'm looking at. You also watch things like, does your standard SUV or ute actually fit in that garage? Maybe it's just me being cynical, but it looks really, really small. And I don't have a huge vehicle, but I'm still wondering, can I actually fit in there? Can it actually fit a vehicle? So moving on to the more interesting parts. So I put in the property value. So yeah, hopefully at the moment you try and negotiate down slightly. To me, it's definitely a buyer's market still. And you'll hear people going, oh, this little area is going up, but it's still very difficult. There's still going to be 3 or 4 months worth of listings at the current sales rate. So take 3 or 4 months of current sales to sell all the listings. That is a long time if you're a vendor. The 40 days, I think, is the average time to sell. It's distorted because some change agents and then go another 40 days there. But if you look at the basic numbers of listings and sales, you're sort of at 3, 4, you might be 5 months to sell all the listings in some places. So it's a buyer's market. I would be aggressive. If it's 41199, 1.2 million, there's no way I'm going to offer 1.2 million. So you try and negotiate for less. There's always going to be some costs to buy. You're going to get normally a building report. You might get a valuation. You're going to maybe set up a company. There's other costs in there. Generally, you'll get some sort of bank contribution. And if you talk to a mortgage broker, mortgage advisor, you should be able to get more than that 5,000, and you should be able to get a reasonably good cash back at the moment. Banks are keen to deal with you. I always work on no money in. If you've got $1 million, fantastic, but you want a return on that $1 million. So always when you first look, work on 100% debt, and that's factoring in a return on your money. This property, I made up the numbers. On the listing, it's got 62,400 of rent. So that would be a 650 for the 3 bedroom and a 550 a week for the 2 bedroom. Will we get 52 weeks? My opinion, a home and income, you've got a shared wall, lots of properties available in Christchurch. Yeah, I definitely, even though it's a new build, it should be easy to rent. I'd drop it down slightly. I'd drop to 51 weeks. And we're looking at long term. You could be a little bit more just at the start, but long term, new build, we're hoping to get 51 weeks. So 61,200 rent divided by our 1.2 million, we're 5.1% gross yield. Straight away, we know that interest rates have been above that. So generally, that is going to pay the interest if it's lucky. It's not going to pay the insurance, the rates, repairs, or all the other costs. So it's a negatively geared property. I've got accounting in here. So standard accounting for one property, we're about 1,800 plus GST, around that $2,000. Insurance, Christchurch is more expensive, and you've got a home and income. So I'd normally go about 1,800 for one property. You've effectively got two, so you're 3,600. Discounted a bit, maybe three. Christchurch a bit more expensive, maybe $4,000. I always work in a property manager. Yeah, to me, legislation and rules are getting harder and harder. It's great to have a property manager working for you. Rates, two properties, so it's going to be a bit more expensive. It's going to be more than normal, so maybe 5,500 is a quick guess. Everywhere is different, and yeah, I didn't get the property file. That would be confidential anyway, but I haven't looked at that. Repairs and maintenance, brand new property, you shouldn't do a lot in that first 10 years, but you're still going to do something. So still $500 a property, $1,000 repairs for the year. I've then just factored in, you might do some education, you might join your local property investors, Canterbury Property Investors Association, Waikato Property Investors, one of the different ones. So costs for there, a little bit of travel. Let's say you're a local and not having to go too far. So you've got 61,000 in, 81,000 out. You're looking at losing 20,000 a year. So that is quite negative cash flow at the start with, and I did that at 5.15%. Interest rates, well, just today we heard, or yesterday, 4.99% for 1 year with ANZ. Not telling you to fix for 1 year or for 2 year or for any other period, but let's say we do the 1 year rate, 4.99. We're looking then at about a $17,500 loss. Generally, from a tax point of view, we would get a valuation done by Valuate. They would come in and value the carpets, the curtains, the dishwasher, the stove, the heat pump, the fences, the decks, the driveways, the path, and there's two of them. So double lots. I would always get Valuate, and even for a new build, the builders could give you a sort of list. It's generally a lot smaller, a lot lower values. Get a lot more out of Valuate for the $550 cost, maybe a little bit more for the home and income. But you're looking sort of probably at least $10,000 off depreciation of year one, giving us a big fat loss. That loss is ring fenced. If this is your first rental, that loss is going to carry forward year after year after year until you make some profit. So you can't offset it against your personal income. So what we're looking for, yeah, is the cash flow. That 17,000 is not looking good. But what we want to do is look over the next 10 years. So I've got rent slowly going up over time, a bit lower this year. It's just a bit of a recession. It's a bit harder. Rents are a bit harder to move up. Then they normally go up 4 to 5% a year. Inflation never going to stay flat 2%, but hopefully it goes up and down and stays around that. Interest rates, I've got going down to 4.5% and then staying on average for that over the next 10 years. Again, they're never going to stay in a perfect straight line. We're never going to get a straight 4.5%, but it's just about impossible to guess interest rates at the moment. They are all over the place. The last 6 months, I would have changed my opinion multiple times. So they might go down more, then they might go up, maybe over the 10 years, sort of average that 4.5. So what does that look like if that happens? Over a 10-year period, this is a new build. We've got on average that it's going to lose or expected loss of $1,800 if it's on interest only. If you can go P&I, which generally you want to pay down debt, reduce the interest next year. It's 21,000, and often banks require you to do that long term. So with this over a 10-year picture, it's actually pretty much break even. It's not a huge loss in there, but you'd be effectively gambling on capital gains. You'd be hoping this property goes up in value, but it's actually more or less covering itself in that 10 years on interest only. If you want to pay it down, you're going to have to put in money. The problem is what happens over the first 3 years. So over time, slowly the income starts going up, but so does your expenses. And if we're flatlining at 4.5, we're looking at expected loss of 17,000, then 10, then 8,000. We're looking at losing 36,000 over that first 10 years. Sorry, first 3 years. Over 10 years, we're only looking at losing 17,000. So then we start to get positive and it starts to cover itself. But you need the cash flow to get through those first 3 years. Would I buy this property? Do I think it's an amazing property and you should all be racing to see that agent and racing to put your deposit in and get this property? It depends a little bit on your situation. Like it's not terrible numbers. I'm not real hesitant. I'm not thinking, wow, this is terrible or it's amazing. It's just an average rental. The problem is that long-term capital gain when you come to sell it. If, like say, you sell in a great market, you should be okay. People get desperate, pay a lot. But if it's a struggling market, are you going to, yeah, how is that going to work? Will you both to sell it? Will you be able to discount hugely or have to discount hugely? So if I was seriously looking at this, yeah, talking to the real estate agent would be a huge part. Sorry, the property management agents. What's the demand like for the property? Is there a good demand for 2 or 3 bedroom properties? And then, yeah, the other part of it, yeah, seeing does it fit in with my aims and goals? And if I did offer, I would want a good discount. I would want to knock that price down a little bit. So therefore, it's going to improve my cash flow. It's going to improve my ability if I have to sell it at a discount. So say you could knock 100,000 off it. If you could get it for 1.1 million basically, instead of 1.2, it then improves your cash flow. Overall, you're starting to make a little bit of money. Your loss in the first 3 years is not so bad. Yeah, so something like that, probably 100,000 minimum discount would be my minimum, and I'd potentially be even after more of that. If properties are not selling, the developer's struggling a little bit, if you can do an unconditional offer and get in that position, they're always going to look at your offer. So yeah, potentially I'd even be a bit smarter with my offer, a bit lower. So personally, wouldn't be interested in this. I'd prefer something with some added value potential. You could do something else with it. But if you're looking for, you've got some good income, you've paid off your personal house, and you could slowly pay this down a little bit. It doesn't work too bad. Low maintenance, easy care. Yeah, if you're in it for the long term, but yeah, definitely I'd be trying to get that discount at the start, trying to get some, yeah, just use that buyer's market to your advantage. 100,000 off makes a big difference to your interest payments, makes a big difference for your potential if you did have to get out in a worst case. So yeah, hopefully you've enjoyed that and hopefully you've got something from that. Thanks a lot. Bye.